Then the next aim statement is asking us to describe how accounting systems and protocols can affect how the risk is presented. Okay, so accounting systems, okay, is what we need to understand. Note that one of the thing about the accounting systems lag the financial innovation. So accounting systems, also the government protocols which are there, they are not as innovative or as active like the market. So market, it innovates in a very short period of time, and these are just lagging, right? So this, the global accounting system that we currently have, it is not up to date with the innovations that we have in the market. Okay, so it does not correctly capture the risk and economic valuation. So currently, if you see whatever the accounting system is, it is not able to capture the risk of an entity. Okay, even in some cases it does not. The accounting system is such a way that whatever is economic valuation, it is not reflected. As an example, this is will cover in the pension, how the pension reporting is done. Okay, this can be seen when the company hedges. Okay, so it does not correctly captures the risk. We'll see this example. Okay, so what happens is, because of this not being up to date, innovators, they take advantage of these accounting inconsistencies. Okay, they try to bring up a product which will circumvent these rules. Okay, so as an example, suppose let's say Goldman Sachs, it enters into a derivative and it books a profit of $200 million. So in that year or that particular quarter, it books a profit. Note that we know that derivatives are zero sum game. So if one party is making money, then there has to be another party who is making loss, right? So there should be another party who should be booking loss of 200 million in the same quarter or in the same year. However, it does not happen because of the accounting inconsistency. They may allow you to book the profit, but losses can be postponed to later period. As a result, it is not correctly capturing the risk of a particular entity, even of the market. So that is because of the accounting inconsistencies. Okay, note that there are some failures which are inherent. Okay, you cannot say that okay, the failures will not happen in the market, they will happen. Okay, right? So all innovations, including the financials, okay, it should lead to failure. Okay, right? Now successful innovations are difficult to predict, so you cannot say that okay, this innovation would be successful in the future, right? So we have to have innovations, we have to have hit and trial and see that okay, whether innovation will be successful or not. We need to give it time, right? So we cannot predict in on the start only that this innovation would be successful. So we need to create a supportive infrastructure. So we need to have an infrastructure which will support the innovation. Okay, note that controls whichever has been put by the government or would be put by the government, they would be insufficient to prevent the breakdown. So it does not mean that okay, you put the control and you will ensure that breakdown will not happen, failures will not happen. No, that cannot happen. So we have seen, like even in the normal cases, like you have so many police are there, still the crime happens, right? So you cannot stop that, right? So controls are insufficient to prevent the breakdown. Failures, okay, please note that failures does not imply that increase in regulation will ensure that no future failures will be there. No, it cannot be said. Okay, then tax rules and regulations, they are different in different countries. Okay, some innovations are designed to avoid tax and rules. So there are some financial innovations which are designed just to avoid these taxes and rules. So government lags the market in setting up the rules. Okay, so it is not that active like the market, right? So what we can say is, one reason for the difficulty is that the challenges to the government is that how they create the realistic model for securities. So they are not able to create realistic model for securities. As a result, they are not able to model the innovative securities for the risk that is there. Okay, so this is the problem with the government. Okay, however, what Myron Scholes has mentioned is that government can limit the innovations through control mechanism. So it can cannot stop, but it can limit. So he's saying that it may prevent future crisis, but we can only hope for this and pray for it, but I do not think so that it will happen, right? So to control the things, we need to have to make sure that government has the information. So to control information is a key, and government should work so that it gets the correct information. Okay, also proper accounting is the key. Proper accounting can stop the growth of many of these contracts which are just created to circumvent the regulation. Okay, so idea is the government should control this type of products which are trying to circumvent around the regulation. If these are stopped, then things would be good, under control. Okay, right? Some examples you'll see. An example is pension fund example. This is a very good example. If you see that California state, okay, it provides pension to its employees. Okay, now California state says that it will issue taxable bonds, okay, and it will buy a broad based stock market index with the proceeds. So the state is saying that, okay, that we will issue bonds to the public, so there will be public investors, and from the proceeds of the bond, what they will do is they will invest in the broad based stock market index, let's say S&P 500. So they will invest in, let's say, S&P 500, right? Now if you were the board of this pension fund, would you recommend it? Okay, most of the board members would reject this proposal. Why they will reject this proposal? Because they will say that, okay, you are investing the money that you receive from the bonds in the stock, which is a risky investment. Okay, right? So it should not be done. Okay, this is what they will say. However, most of the people will go in case of pension plan. Now see about the what we say is the similarity of this product, okay, of this step that is there, and the pension plan. So in a pension plan, what happens? Okay, California will promise pension benefits which is indexed to wages, which are indexed to bond return. So California government will say that I will give you future payments, okay, to XYZ employees, okay, which will be based on the bond return. Note that here also state will take the return from the S&P 500 and it will pass on coupon. So these coupons will be passed on to the public. So here what California state is saying, that it will it takes money from the employee and it promises to pay some money in the future. Okay, and what happens to the money that it takes from the employee? It invests in the market, okay, in the stocks predominantly, right? So it says that I will give you future benefits which are wages which are indexed to in bond returns, okay, and this invested, and these people they invest the foregone wages in a portfolio of the broad market common stocks, right? So this is accepted, okay, and yes, it is accepted because pension is a product, okay. So there is a lot of similarity between the two. Here also you are promising future payments based on the returns you get from the market. Here also you are promising future payments based on the return from the market, but this is wrong and this is correct. Why? Okay, why? Right? It is, both are similar, right? So what they say is the same holds true for corporate pension plan also. Okay, the issue is that because as per the accounting, this would be treated separately and this would be treated differently, right? The pension promise, okay, that is the future payments that you are making, and the fundings are not recorded as liabilities and assets on the financial investment. They are not properly recorded. Okay, note that there have been changes in the standard after this paper has been written. Okay, so there are some changes wherein now as per at least US GAAP, the pension is being recorded properly, but still IFRS it is not recorded properly. So we have this, because of this there is a loophole, so people are going for this kind of thing. Okay, then money market mutual fund example. So money market mutual fund which is investing in the bonds, okay, which are not bonds but short term money market instruments which are risky. Now but the money market in mutual fund, it promises investors some return. How can it promise investor a return when the underlying securities are risky? right? It cannot promise. Then banks, please note that banks are allowed to account for returns, okay, for illiquid securities during a period when they are coming up with a return. Even for the illiquid securities they are allowed to account, right? Now note that these illiquid securities you are allowed to account for the return as per the current market valuation, okay, but it should be allowed only when the banks they keep a reserve for the cost of liquidation prior to maturity. So let's say you have illiquid securities, you are saying that last quarter the value was 100, this quarter the value is 105, okay, so you say that okay 5 is the gain, but if you go in the market and sell this illiquid security you may get only 102, okay, so you have to appropriately reduce these three, okay, when you are making this profit you have to keep a reserve so that this is a cost of liquidation, okay, so that is the idea. So you are allowed, but as per the accounting is not correct, you should do a reserve for that the liquidation reduces the valuation that you will get.